Welcome back to Price Action Framework. In Part 1, we learned how to identify a valid shooting star, but finding the pattern is only the first step. Most shooting stars fail because traders ignore four critical factors: structure, location, context, and confirmation. These four elements separate ordinary patterns from high-probability setups. Let's get started. In Part 1, we focused on structure. We learned that a valid shooting star should have a long upper shadow, a small real body, and little or no lower shadow. Structure helps us identify the pattern. But here's the mistake most traders make. They see a valid shooting star and immediately assume a reversal is coming. That's not enough. A valid shooting star is not automatically a high-probability setup. Professional traders also evaluate location, context, and confirmation. Because structure helps us identify the pattern, but location, context, and confirmation determine whether it's a high-probability trading opportunity. Let's move on to what may be the most underrated concept in candlestick trading: location. This is where many traders start making costly mistakes. Many traders know how to identify a shooting star, but very few know where it actually matters. And that's a problem. Because a perfect shooting star in the wrong location is still a bad trade. Remember, the candle itself is only one piece of the puzzle. The candle tells you what happened. Location tells you whether it matters. A shooting star forming in the middle of nowhere is usually just market noise. But that exact same shooting star, forming at a major resistance level, becomes a completely different story. Structure identifies the pattern, location gives the pattern meaning. And that's what separates ordinary patterns from high-probability setups. So the next question is, what actually makes a location high probability? In simple terms, we're looking for areas where sellers are likely to defend price. In many cases, those areas are called resistance. A shooting star by itself is simply a candlestick pattern. But when a shooting star forms at resistance, it becomes much more significant. Why? Because resistance is an area where sellers have previously shown they're willing to defend higher prices. When price reaches resistance, buyers and sellers begin to battle for control. And that's exactly where shooting stars become interesting. In the price action framework, we want to see a shooting star form at a meaningful resistance area. Because the more meaningful the resistance, the more meaningful the rejection. Let's look at some of the most common forms of resistance that professional traders pay attention to: trendline and channel resistance, horizontal resistance, role reversal, also known as change of polarity, moving average resistance, Fibonacci resistance, and psychological resistance. Each of these locations can increase the significance of a shooting star. And when several of them come together, the setup becomes even more powerful. Remember this formula: a shooting star plus meaningful resistance equals a high probability setup. Let's start with our first high-probability location, channel resistance. This is one of my favorite locations because it appears frequently across different markets and time frames. I especially like using parallel channels on the daily time frame. So before we look at the shooting star, let's first understand what a channel is. A channel forms when price moves between two parallel boundaries. The upper boundary acts as resistance, while the lower boundary acts as support. But here's something important. Not every pair of parallel lines forms a valid channel. For a channel to be meaningful, price must respect both boundaries. As a general guideline, I like to see at least 5 touches in total. Typically, that's 2 touches on one boundary and 3 on the other. It doesn't matter which side comes first. The key is that price has respected both boundaries multiple times. The more times price respects the channel, the more significant that channel becomes. Now that we know how to identify a valid channel, let's see what happens when a shooting star forms right at the upper boundary. Now, let's apply what we've just learned. Take a look at this chart. Notice where shooting star number 1 formed. It appeared right at the upper boundary of the channel. Remember, the upper boundary of a descending channel acts as resistance. As price approaches that resistance, buying momentum often begins to fade, while sellers become more willing to defend higher prices. That's exactly why this shooting star is important. This rejection wasn't random. It happened exactly where we would expect sellers to become active. Now notice something else. This shooting star also has an exceptionally long upper shadow. As we discussed in Part 1, a long upper shadow is a sign of strong rejection from higher prices. So now, we have both structure and location working together. The shooting star gives us the structure. The channel boundary provides the location. Together, they create a much higher probability setup than either one alone. But here's where things get even more interesting. This isn't the only reason this location is important. There's another layer of resistance hiding in exactly the same area. Let's take a closer look. So here's the second layer I mentioned. Take a closer look at shooting star number 2. Yes, it formed at the upper boundary of the parallel channel, but that's not the only reason this setup is interesting. The same price level also lines up with the 61.8% Fibonacci retracement. And that's still not all. If you look to the left, you'll notice this same price level also acted as a previous swing high. In other words, we also have horizontal resistance, so now we don't have just one resistance level, or even two. We now have 3 independent forms of resistance, all pointing to the same price level. The more independent reasons we have for price to react at one level, the more significant that level becomes. That's exactly what professional traders look for, and this leads us to a very important concept. When multiple independent forms of resistance point to the same price level, we call that confluence. Confluence doesn't guarantee a reversal, but it does increase our confidence that this location is significant. Think of it this way. Structure identifies the pattern, location gives the pattern meaning. Confluence strengthens the location. The more independent pieces of evidence we have, the stronger the overall setup becomes. Professional traders rarely make trading decisions based on just one signal. Instead, they look for multiple independent reasons for price to react. Because trading isn't about predicting the future, it's about stacking the odds in our favor. And remember, no single factor guarantees a reversal. Even with confluence, risk management is still essential. If you're finding this lesson helpful, consider subscribing to my YouTube channel, Price Action Framework, for more in-depth price action tutorials. Now that you understand confluence, let's move on to our second high probability location. Horizontal resistance. This time, instead of using a channel as our resistance, we'll use a previous high. Horizontal resistance is one of the easiest forms of resistance to identify. It represents a price level where the market has previously struggled to move higher. Now take a look at the left side of the chart. Price rallied into this area, but buyers couldn't push any higher. Sellers stepped in, and price moved lower. That swing high now becomes an important resistance level to watch. Now fast forward, price rallies back to the same level. Once again, buyers try to break above resistance. But this time, a shooting star forms right at that previous high. That's an important clue. It tells us sellers are defending the same resistance level once again. This isn't just a random shooting star. It's a shooting star forming at a proven resistance area. That's what gives the pattern significance. Markets have memory. Areas that acted as resistance in the past often become resistance again. That's why we often say, previous highs can become future resistance. That's why previous highs deserve our attention. Remember, we're not simply trading candlestick patterns. We're trading rejection at important locations. Before we finish this lesson, let's quickly recap what we've learned. We started by understanding why location is one of the most important parts of the price action framework. Then we explored channel resistance, horizontal resistance, and the concept of confluence. Remember, a shooting star by itself is just a candlestick pattern. It's the location that gives the pattern meaning, and when multiple forms of resistance come together, the setup becomes even stronger. That's exactly how professional traders evaluate trading opportunities. But we're not done yet. In Part 3, we'll continue exploring several advanced resistance locations, including role reversal, moving average resistance, Fibonacci resistance, measured move completions, and psychological resistance. These concepts will help you identify even higher probability locations for shooting star setups. If you're enjoying this lesson, don't forget to subscribe to my YouTube channel, Price Action Framework, for more in-depth price action tutorials. Thanks so much for watching, and I'll see you in Part 3.